How can managers effectively assess business performance? This video explores fundamental financial and management accounting techniques used by managers. Discover how these methods can enhance decision-making in organizations. Understanding financial and management accounting is crucial for managers. It helps in applying techniques that improve organizational performance. This section delves into essential concepts and skills. These skills enable managers to analyze and interpret financial data effectively. The aim is to enhance decision-making capabilities. Evaluating business performance involves analyzing key metrics. Financial performance is assessed through profitability, liquidity, and solvency. Operational performance focuses on efficiency and productivity. Market performance examines market share and sales growth. Stakeholder satisfaction considers customer and employee engagement. Profitability measures like net profit margin reveal profit generation. Liquidity ratios assess the ability to meet short-term obligations. Solvency ratios evaluate long-term financial stability. These metrics provide insights into the financial health of an organization. Understanding these is vital for informed decision-making. Efficiency metrics like inventory turnover highlight resource use. Productivity measures assess workforce and process effectiveness. High efficiency indicates optimal resource utilization. These metrics help identify areas for improvement. Operational performance is key to sustaining business success. Market share reflects a company's competitive position. Sales growth indicates the ability to expand customer base. These metrics show market reach and competitive strength. Understanding market performance is crucial for strategic planning. It helps in identifying growth opportunities. Customer satisfaction measures loyalty and satisfaction. Employee engagement indicates effective human resource management. These factors influence organizational success. High stakeholder satisfaction enhances reputation and performance. It's essential for long-term sustainability. The balanced scorecard incorporates financial and non-financial measures. It provides a comprehensive view of performance. This includes financial, customer, internal processes, and learning perspectives. Strategic performance is vital for holistic evaluation. It ensures alignment with organizational goals. Managing working capital involves balancing short-term assets and liabilities. It ensures liquidity and operational efficiency. Key components include cash balances, trade receivables, and inventory. Effective management avoids liquidity issues. It supports continuous operations. Cash balances are vital for meeting immediate expenses. Optimal levels prevent liquidity issues. Cash flow forecasting predicts cash needs. It avoids idle cash and ensures financial stability. Effective management supports operational continuity. Trade receivables are amounts owed by customers. Timely invoicing and discounts encourage early payments. Credit control policies reduce bad debt risk. Effective management improves cash flow. It's crucial for financial health. Trade payables are amounts owed to suppliers. Utilizing credit terms improves cash management. Timely payments maintain supplier relationships. Negotiating better terms can enhance financial flexibility. Effective management supports operational efficiency. Inventory management balances stock levels to meet demand. Avoiding overstocking reduces holding costs. Systems track stock levels for efficiency. Just-in-time techniques optimize inventory management. It's vital for operational success. Ratio analysis simplifies financial statements into metrics. It aids in trend analysis and forecasting. Ratios facilitate industry and competitor comparisons. This analysis supports financial decision-making. It's a key tool for performance evaluation. Liquidity ratios assess the ability to meet short-term obligations. The current ratio measures asset coverage of liabilities. The acid test ratio excludes inventory for a stricter measure. These ratios indicate financial stability. They're crucial for operational continuity. Profitability ratios evaluate profit generation relative to sales. Markup indicates the percentage added to costs. Gross profit margin shows revenue exceeding costs. Net profit margin reveals profit after expenses. These ratios highlight financial viability. Efficiency ratios measure resource management effectiveness. Inventory turnover shows stock replacement frequency. Receivables collection period assesses payment collection time. Payables payment period indicates supplier payment timing. High efficiency indicates optimized resource use. Comparing ratios with historical data reveals performance trends. Industry averages provide competitive context. Benchmarking against similar organizations aids in performance evaluation. This analysis identifies areas for improvement. It's essential for strategic planning. Ratio analysis simplifies complex financial data. It aids in trend analysis and forecasting. Ratios facilitate industry and competitor comparisons. This analysis supports strategic decision-making. It's a valuable tool for performance evaluation. Ratios rely on historical data, which may not predict future performance. Differences in accounting practices can affect comparability. Qualitative factors like market conditions are not captured. Despite limitations, ratios provide valuable insights. They should be used alongside qualitative analysis. Ratio analysis aids in informed decision-making. It provides a clear picture of financial performance. This supports strategic planning and investment decisions. Management can optimize cost management and growth strategies. It's essential for organizational success. In conclusion, being able to assess business organization performance is essential for understanding how effectively a company is operating and where improvements can be made. By using financial and management accounting techniques such as ratio analysis, budgeting, variance analysis, and performance indicators, managers can evaluate profitability, efficiency, liquidity, and overall organizational health. These insights support informed decision-making, strategic planning, and continuous improvement. Assessing performance accurately enables organizations to remain competitive, achieve their goals, and drive long-term success. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748436168.